Hey guys, in this video, we're going to cover um, one of the patterns that we look for in our charts to identify an opportunity uh, to either go long or get short. Um, Really, we use it on any product in any time frame. Um, as always and as usual, we always put more weight on the bigger time frames, which we typically stick to when we trade. But it can work and does work on any time frame. And you'll see that we have a couple examples in a couple different markets. I have a stock example, I have a forex example, and I have a futures example. And the stock example can be applied to all of our options traders out there. Um, you just obviously you're going to trade options instead of equities, but you're basing it off of the underlying equity and its price and chart pattern and what it's doing. So, um, uh, yeah, let's just get started. So the pattern that we're looking for and what we like to call it is basically the W or reversal pattern. It's nothing special. It's nothing new. Um, a ton of people know about it. A lot of traders know about it. Big traders, small traders, retail, professionals. It's just a matter of finding it in the right place and then taking the appropriate action when you see that pattern setting up. And that's what trading is all about. Because everybody's looking at the same thing. Everybody's looking at the same charts. It's how you interpret the data, how you interpret price, previous price action, current price action relative to previous price action, and what it means going forward, and really how you can use that to take advantage um, of the markets and extract some money out of it consistently, and that's the whole key. And so, like I said, one of our favorite patterns that we look for is the W or M or mountaintop, if it's for shorts, reversal pattern. It's a reversal pattern um, that we use in conjunction with a few other criteria to get to our uh, trade setup, if you will. It's got to meet other rules and other things in place for us to execute the trade. But what we look for first and foremost is basic chart patterns and where price is at relative to where it's been. And that's why we use technical analysis. That's why we use candlesticks. It just gives us the most simple, easiest visual representation of the setups that we're looking for. We're looking for, um, you know, uh, opportunities where we think price may reverse from, bounce from, change direction from, whatever you want to call it, however you want to call it, anticipatory, technical analysis, whatever language you want to use. We're just trying to find um, low risk, high probability, high profit potential opportunities using charts in all markets, equities, futures, commodities, forex, doesn't matter. And so the same principles apply. So like I said, it's a reversal pattern. We're looking for the chart to basically set up a certain way. And we're looking at TradeStation right now, and this is a stock. This is HOG, Harley Davidson. We actually have a position on in here. And what we're looking for is a bounce back up to this 46 area. Is really our first target, and then second target would be much higher, um, up towards this 52, where the origin of the gap down occurred. Now this can take many months, the rest of the year. It just depends on the time frame that we're looking at. Right here, we're looking at a daily time frame. Like I said, this pattern plays out on any time frame. It's just a matter of what type of trader are you is going to dictate what time frames you're looking at. Okay, and so again, this is a reversal pattern. You can see prices had been coming down steadily for months, months and months and months, really since February when the markets really took a nosedive. Um, pulled back, moved down, just made lower lows, lower highs, lower lows, and then it started to base a little more than just go straight down. And then you had some rallies in here, and then it made some new lows. You bounced off the lows. You tested some recent highs. You had a further retest, and then this is where the opportunity lies. So taking what I said and interpreting price moving in those certain ways, we're getting a visual representation of basically some pullbacks with some rallies. And what happens is price forms a certain pattern. And that pattern is what we're looking for. If you remove price from the chart and just leave the lines on that we have drawn based on what price it did, it gives us this formation. And if we have this particular formation, this reversal W formation, in an area that's at or near demand, which is to the left, then we can find an entry point based on this pattern. If this pattern we see forming at an area where there's some demand to the left, then we're going to go ahead and look for a particular point to get on board this trade. And so what we want to do is wait for this right side of the formation of the pattern to form. We're going to be looking at it when prices are right about here. We've identified the demand zone. We see that price has come down close to it, didn't get down into it. It tried to rally out, it couldn't, failed, and made a new low, and it actually hit the area of demand that we like, where more buyers are going to come in, no more selling. We see prices reversing. And it can either take this high out or not, but there's, on a smaller time frame, an area in here in this move up where we're going to wait for a retest to hop on board. So typically we can go down to a smaller time frame. If you're using a daily, you could go down to a 240 minute or a 60 minute if you need to. Not necessarily, you don't need to all the time. If certain candles in a formation looks okay on the daily chart, then you don't need to drill down a little bit further. You can just simply wait for the retest to occur. In this case on Hog, that's what happens. I'll put price back on here and you'll see that. But basically we're getting in on this right hand side of the W formation on this last retest before price breaks out to new highs. In this case, it's going to be our opposing area up in here, where we can see some selling pressure potentially, and then a second target much higher up here. Okay, so this is one of our favorite patterns that we look for. Like I said, it doesn't matter the time frame, doesn't matter the market. We look for it on stocks, futures, commodities, forex. It's all the same thing. Let me show you a couple examples. Here we have the NQ, which is a futures contract. This was last year, 2017, and this is on a small time frame at 2000 tick bar chart. So time, it's a small time frame is what I'm saying. And so, all things being equal, what we see here is the market coming down, putting in a new low, rallying back up, getting rejected, and then putting it in a further new low or a new low down here, gets rejected from going any lower, bases and reverses, takes out this previous high right here, and then we're getting the pullback. This is where we want to hop on board. We want to see this price action happen where it comes down and you have almost a stair step into the level. See it take out. Doesn't necessarily need to, but it can. It's helpful if it does. Takes out this previous high, this previous pivot high, and then we simply wait for a pullback into an area of demand down here on this bottom portion. So it's the right-hand side of the formation of the pattern, with the demand being somewhere in this middle move to the upside. So we quantify that define how much risk we want to take, determine our position size, determine our stop loss, determine our targets, and then, and only then, do we execute the trade. Now, a profit target, potentially, or let's start with the stop loss. The stop loss is going to be key. So you're going to identify a level somewhere down here, and in this pattern, we have a little pause and a rally out off of this buy candle, which is the reversal candle. So the entry would be here at 58.97 based on this middle base candle. And then the stop would probably, you'd want to be the safest, you'd want to put it down below this bottom wick, which it looks like it's probably closer to 58.85, another 5-10 points below. So your entry is up here, a stop would be down here. Profit target, first target would be a break or close to these highs right here, this high and this high. So first target could potentially be in here. There's another way, an alternative way to do this is if you have predetermined profit targets, like a 1-to-1 or a 2-to-1, you can have that as an initial target and then base your second target on the break of this level with a move higher in anticipation of it getting back to the origin of the drop. So this is where it dropped off initially. We have some confluence with the previous close of the previous day and the open for this day's trading. Those are two data points we like to keep in mind. Price has a tendency to revert back to these types of levels, these types of price points. You'd be surprised. You just need to track it. But price has memory, and it typically returns to areas where it moves away from. So, a target somewhere up in here would have been, ideal as well. You can have a profit target pretty close, and then you have a second target for additional contracts up much higher. And depending on the time frame, this is a small time frame. You can have much bigger profit targets. If you were doing this on a daily, like with Hog, for example, if we go back to that, risk to reward, you're risking about $2.50 to potentially make almost $10 on this second profit target, this bigger profit target. So it's over a 3-to-1, 4-to-1. That's what you want. That's the type of risk to reward ratios that you want. Another example would be, let's go into this. This is our Forex example. This is the dollar yen spot pair. And as you can see, this is a 60-minute. So the time frame is different. We've had a daily with Hog. We've had a futures trade with ENQ on a 2000 tick. So that's anywhere from seconds to minutes, depending on how fast the market's moving and what time of day. And now we have the US dollar and Japanese yen Forex pair, spot Forex, and it's on a 60-minute. And surprise, surprise, the pattern is exactly the same. Exactly what we're looking for. The markets change, time frames change, but what we're looking for doesn't. Price, again, has memory. There are patterns in price action. If you're able to understand, how to read and what to interpret out of these charts, trading can be pretty simple. Now, getting into the whole mental side and dealing with all that and the emotions and building up accounts and dealing with losses, that's a separate issue. What most people can't even understand is being able to find some simple patterns that they can use in whatever market that's repeats over time and find a way to extract some money out of those setups. Trading is all about having an edge, and an edge is just something that's a probability of something happening higher than over something else. So if you can put the edge in your favor when you're trading, manage your risk, have the proper risk to reward ratios, you can consistently make money, even if this was the only pattern you trade. And you can trade it only from the long side. You don't even have to trade it from the short side. Because this thing, you flip this baby upside down and it's literally the same thing. You'd just be looking for shorts instead of longs. So um, the pattern, again, guys, is the same thing. We're looking for a move down, an attempt to rally out. It can't do it yet, but it's absorbing all of these orders, filling everybody up here, reverses further, comes down into the actual level of demand. This is where we would want price to come into uh, our predetermined level, see it move out of there, break out some highs, and then have our entry set up ready on a pullback back into this middle portion of the move with the anticipation of it breaking out of all of these highs and moving back up to the origin of the first drop down. Or if there's an area of supply in this case, that's where we would want to have our targets at. So that's the pattern. That's what we're looking for. It's one of our favorite setups. Like I said, it's a reversal pattern, so you got to look for it at areas where you'd be selling or areas where you'd be buying. You'd want to look for this pattern in those particular spots and then take the right action based on those moves. All right, guys, that's it for today. If you guys want to, learn more and see this real time and see this over and over and over and see how real traders, extract money from these opportunities, then check out our website, check out our YouTube channel, join the group coaching room, get involved, learn as much as possible, guys. Find something that you like and do it over and over and over, and the rewards will come. All right, that's it. We'll see you next time, guys.